Hey everybody, Brian here from quantlabs.net. Okay, so here we are on my YouTube channel. What we've got going on is I wanted to go over some of the past videos before I show you some items, a new script that I got. So first things first is we've been, the last probably 3-4 weeks, we've been focusing a lot on this forex strategy. Involving forecasting volatility to predict market direction on currency pairs. So this video is important to watch as a backstory. This is a webinar that Shalom and myself did to introduce the different types of volatility out there to do exactly the forex forecasting on currency pairs. And the one I came away with that probably is the most useful is average true range. So I went ahead here and wrote a ATR script in Python that does measurement of volatility across 55 currency pairs provided by IQFeed, which is essentially their source is FXCM. So we've got this script running, or can run. This one right here demonstrates a scan of those 55 currency pairs, and the one that came away as the most volatile for up until this year, 2016, was US dollar and Hong Kong dollar, and that was easily identified in these spreadsheets that the file generates. So we came across to here, tradingeconomics.com versus Quandl for forex trading data. Now, this is an important video to watch because there are probably maybe 20-25 drivers that will impact currency pairs or indirectly impact the currency or the country that the currency comes from. So for instance, we're talking US dollar, we're talking about the economy of the US, the Fed of the US, so forth, and of course we would go on about Japan, Britain, the Eurozone, so forth. So here in this video I showcase about 5 drivers that you could use to compare the sources of the info that you would need or the data from both tradingeconomics.com and Quandl. So I'd watch that to get more detail on 5 additional drivers that will impact forex trading. So this new video that I'm doing, again, this is another Python script that I got. It's a very small one, but I have been going on about now for a while about Python. The code can be very concise, as you can see here. It's about 48 lines. Let me show you what it does. I'm not going to do a code walkthrough, but I just want to run it and show you what it's doing. So it's running right here. We get this little green circle. You can see how fast it is. Now it's done. Okay, so if we go into our folder here of where these this exists, what we're essentially doing is this script, the Treasury 10-year, is being downloaded from the Fed or the Fred St. Louis part of the Fed, and they provide data. I've gone on about that. It's pretty easy to find. But what this does is it will download data of the Treasury yields weekly since the 62, and there's 4 charts that this will show. The first one I'm going to show you is just basically the rate of the yield of Treasury, and basically it will show you historically how the yield has performed for the US 10-year Treasury. Now this is another big driver that will impact the US dollar based upon the performance of weekly yield coming from the 10-year Treasury, which is a standard benchmark for institutions in terms of trying to get return. So as you can see here, this is the yield weekly since 1962. You can see that we had some good times, well, not really good times, but if you're just a bond trader, you were done quite well up until about this period, about the late 70s, early 80s, during the stagnation, and since then it's been a steady downhill from there. And in fact, the yield is lower now than it was in the 60s, which is obviously not a good sign. I believe a lot of this has to do with manufacturing coming out of the World War II, 50s and 60s, the boom with the baby boomers and all that. And then we are just in a steady, or the U.S. and pretty well the rest of the world, at least the West, is in a steady decline. And it's now lower than it was in the 60s. So that is a pretty stark chart. And we've had little blips, but it's definitely on its way down. Now this chart here, which is measuring the rate of change of that yield on the weekly basis. And here it's really interesting because you can see the volatility of the U.S. Treasury yield over the 10-year Treasury on the swings and the volatility of that yield. And again, that's weekly. So you can see here we get movements of up to 15%. So you know something pretty significant going on here, and that's obviously in the 2008 financial crisis. And again, here we've had another fairly deep decline, and I do think when you get these sort of drops in the yield, that is something, again, not exclusively, but again, that you can use to measure the predictability of both the U.S. economy, and especially it's an indicator of something the Fed will have to do to counteract the U.S. Treasury to keep that yield stable. Obviously uncertainty and where it's not clear there's no clarity in the U.S. Treasury, of course there's going to be volatility, and that it can be a very dangerous time for a lot of investors, business operators, and so on and so forth, and generally the economy, because it's not stable. So here you can see what I'm talking about is very true in terms of if there's no clarity with the Treasury yield, we are in trouble. And it's not as deep yet, but there it is. You can see we've got something here, and the question is, it's a little deeper than the preceding massive drop here in 2008, but it's a little deeper than the first one. But it's something you can easily watch, and the volatility has been increasing on the U.S. yield over the last, I guess, 8 years. So this is a very important measurement or indicator that you can watch to see how the U.S. Fed will react to with their interest rate policy. Very important. And of course that will impact not just the U.S. dollar, but will impact anything that trades around the U.S. dollar. And you can pretty well say the same thing with any currency in the world, any major currency in the world. So these are things that we need to be on the lookout for, okay? Now, this is since 1962, but I have another set of charts similar, but are since 2000, so we can get a more detailed look to see what's happening. So you can see here, generally the Fed has been trying to inflate, because it is deflationary, what we're seeing here, has been trying to inflate the economy, and is consistently, a little short term here, but it's consistently on a downward trend over the long run. So not a good thing, and it's dropping here. If you ask me, we are at 1% or pushing towards it on the 10-year. I think all hell will break loose once you start seeing zero pop up on this chart. And again, remember, this is weekly. Once you start seeing that zero and the 10-year Treasury yield drops below zero, that's when all hell will break loose, because from my perspective, I do think that that's going to mean no more confidence in the U.S. economy, no more confidence in the U.S. Fed, and obviously there will be a search on for a better alternative, which I think unfortunately will go back to the gold standard, where gold will be the standard. And if you're not watching this carefully, and you're not buying into your hard gold assets, not meaning like physical gold we're talking, We're talking, most people probably won't believe it, but if you're just trading off of paper derivatives of gold, like mining companies, ETFs, so on and so forth, you're going to be in trouble because that will still sink because it's derivatives of hard assets like physical gold. Very important to understand that and make sure you get yourself gold, physical gold, and make it available to yourselves because that will be the ultimate hedge against this eventual event. You can see it right here in the charts. So let's pull up the that dispersion on the rate of change. So you can see here in 09, major drop, slight improvement. Again, it's dropped here in 15, now 16, probably the last month. So the question is, right here, we're starting to see things, from my perspective on the U.S. Fed, Treasury yield rate, something is going to drop, and this volatility is just going to go crazy. You can see it since 2001. It's been not too bad, stable, but the dispersions of it has just been crazy. The movement have been a lot more volatile. So again, these are really important drivers that will impact the U.S. dollar and anything that trades around it. If you've got a system that watches this, knows what to look for, and other combination of indicators. The unfortunate problem is you can do very well because you know what you're looking for, and hey, it's not my fault because Joe Blow in the factory doesn't understand working at a factory and road mapping their life for the inevitability of something going on with the eventual, call it, but it'll be hell-bent, that's for sure. And, I'm personally thinking, we need to be very, very aware of that because, there's a lot of countries out there that are trading below zero. Germany's a big one, Japan's a big one. People are already giving up on Japan. The Bank of Japan has run out of ammunition to fight this problem of negative yields, and it's a world of hurt, a world of trouble, and I have no idea what the solution is. I know what the solution is, but I'm not going to get into this conspiracy theory and doom and gloom sort of thing. But it is important to see the numbers don't lie, the data don't lie. You can see it in the charts that's being generated through systems like this. That's why I always tell people it's so critical to have your charts and your automation happening because you see this, because you're not going to read about the news, you'll get the hints, but when you see it from yourself, from the raw data, you go, wow, that's pretty good. But the dispersion is never talked about here, and again, it's these things, we know there's going to be a problem, we just don't know when. I think I know when because it's telling itself right now. General trend down, once we hit that zero, and even if I think we break one, that's going to be the big warning sign. But once at the inevitable going below zero on the interest rate of the 10-year Treasury, or the yield, sorry, if that goes below 1, I think that's going to be a big problem because this is the only last stand benchmark used by global players to get any kind of yield they can, and this is why this is the only game in town right now. And you can see the desperation going on with this, and I think who knows where we'll go, but there's a lot of desperate things going on, and you can see why. So again, just even if you don't believe the forex stuff or the global macro stuff I'm doing, I think we need to be aware of that 1% on the 10-year Treasury is something to be very cognizant of, and once we breach that, then I think it'll be a matter of time before we hit zero, because this is where the confidence factor will eventually be lost. I have no idea how long it will take, but if you were to look at the trend, we're probably looking within, I'm going to estimate this is probably April, May 2013. If you look at that general trend, you could probably predict it will start to happen within most likely 2 years. If you were to look at this one just after 2011 and that drop all the way down, you're probably looking at just over a year and a bit. So historically, we can get a rough estimate of time before we breach that 1%. So I just wanted to put that out there and to highlight two things. Automation is very powerful when you start seeing this, looking at the chart yourself. And of course, this will heavily impact the US dollar, because I'll tell you from my own trading, which I'm sitting in quite a bit of US cash, since about this time. It's just been down, down, down. I'm not getting any yield on the U.S. dollar. Even though the goons that you see on Bloomberg, not the anchors themselves, but some of these peons that they bring on, saying, "Oh yeah, the U.S. dollar is where you should play." You can see why there's no return on the U.S. dollar, because the yield drops on the 10-year Treasury, so does the U.S. dollar, and you can see why. Those guys are wrong. I bet on that, and I'm wrong because of it. And now I'm not getting really any return on the U.S. dollars that I purchased back in about 6-7 months ago. So not a wise move to listen to talking pinheads on media, and do the charting yourself, and try to get the automation working. So hopefully you enjoyed this video, you learned some stuff, and I'll talk to you soon. Okay, and again, there's an introduction I've given you to 6 drivers out of probably 25 that you can use to measure currency pairs and the impact of currency pairs from a variety of things. Over and out, later.